This is about the debt. It's not about 35 trillion, guys. It's about how fast is that debt moving.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pains.
That's going to be bonkers.
Hey everybody, and welcome to another episode of Talking Trades with myself, Kevin Wadsworth, and my friend and business partner, Patrick Karim. Patrick today is going to talk to you about the explosion of public debt, the explosion of national debt. What does debt mean? And more importantly, not just the size of the debt itself, but the rate at which that debt is accumulating. What does it mean for the markets more generally? Very illuminating stuff. Patrick, take it away.
Yes, Kevin, thanks for that intro. Look, I'll share the screen while I do my intro there because you guys could ponder this image while I preface this. What you have here behind you guys is the total public debt for the US since 1966 all the way to today. So the total public debt is internal, external, government debt, like the whole shebang, right? How much money they have to print or borrow to pay for programs, etc. It's all there. So people often will say, oh, the debt's 35 trillion. It used to be 319 billion. And here halfway through some other number. And people, it's a big number, right? For 35 trillion. And it always makes people, well, they've printed so much. Well, the markets, they kind of anticipate this growth, right? This is on the log scale chart. It doesn't matter that much, the total amount of debt, as long as it's the explosions, the changes in momentum, the accelerations and decelerations of that debt, which is always going from bottom left to top right. That's when the market needs to reprice something. That's when there is a new bull era in commodities or in gold silver miners, or on the flip side, in growth speculative asset classes like tech and Bitcoin. So that's step one, understanding that bottom left to top right, 35 trillion debt is not that critical. What's more important is the rate of change of it. So here in the bottom, or another way I can measure change is distance from moving average. So right here, this is the quarterly chart. Every time there's the line advances here, it's 1 quarter. Here I have the distance from the 6 quarter moving average. So essentially that's a year and a half. Now, when you see the distance from moving average goes down, that means that we know that the debt's always going up, right? But it's not going up as fast. So the distance between the total debt level and the 6 quarter moving average is shrinking. So that's why this is going down right here, is the debt's going up. It always goes up, but it's not going up as fast. And it's a key point to notice this. Look, I have the overlaid recessions here on top there, these green overlays. When the debt starts exploding and breaks out, with doing classical TA there, you could identify some breakout lines, right? Lower highs, and then it explodes. What do you get? Exploding debt. The rate of change. So now it's going, you could barely see it on the chart, but the debt's actually moving up faster than it normally does. Why is that happening? Well, you get recessions often on these breakouts. The government has to take on more programs. They have to bail out people. Like, insert your favorite reason. High unemployment, the money, the government is trying to spend its way out of this economic rut. Recession, bam, explosion debt. Now everything's good. It keeps printing. That line keeps going up of debt, but it's not going up as fast. That's a recovery cycle for growth stocks, etc. Look at that explosion in debt, recession, etc. But look at the bigger cycle. See these ebbs and flows, higher lows, higher highs. That whole period from 1970, guys, all the way to 80, guess what? That was a bull era for oil, gold, silver, gold and silver miners. You see that? And the U.S. equities were going sideways during that time. So all these hard recessions that had during the 70s, it stifled the growth stocks, right? The SPX, all that, the growth speculative stocks, they had a hard time there. So that's important to know. And here, look at this unwind. The debt keeps going up. It keeps going up during the whole 1980s, all the way to 2000. But look at the distance from moving average. It's not going up as fast. The markets are reprieving. They don't have to print as much money. The recessions are shallower, not much. See, there's an explosion in debt here, but not as much, still lower highs, etc., until it totally deflates. Then you get the dot-com bubble, the recession of the early 2000. Guess what? Recession, explosion in debt. And now we're starting a new cycle, higher lows, higher highs, then get the 2008 GFC, have to print even more. So this whole period here, all the way here, was a bull era for gold, for silver, for oil, uranium, copper, etc. And U.S. equities just had a hard time, right? From 2001, I think it's 2011 or 12 that they managed to overcome their 2001 highs or 2008 highs and broke out. So that whole period was a place to be for alternative asset classes. Here, deflation again, deflate in the distance from moving average. It keeps going up, guys. The debt keeps going up, but it's not going up as fast. And that's the Rosetta Stone, right? This is the key to unlocking these macro market cycles. And then the tech stocks, crazy bull run, had a great time. Here in the 2020 spike, we had that micro recession. Look at the debt just exploded. Again, every time there's a debt explosion, we get these recessions, then deflates. But once that went to pass through, the tech, the growth, the Bitcoin, all that still had a great time. So now, where are we today? There's no explosion in debt yet, right? This could have been the bottom, but we don't know. We're waiting for an explosion in debt, whether the Fed or the governments, there's more and more unemployment, even if they don't declare that there's a recession going on. The government's going to start spending more and more and more to try to alleviate these economic symptoms, right? They don't like people, not having jobs, stuff like that. They want to keep people happy, so they'll take on more public debt. So if the acceleration outpaces the moving average to a point where we close above this line, probably have maybe a third reaction on it. We'll see how it reacts here, then breaks out. Then we're back into a situation like 2007 or 8, 2001, etc., and all of these. And that's where gold, silver, oil, miners, all that stuff, copper, uranium, insert, will generally outperform the other type of assets like the indices, NASDAQ, Bitcoin, etc. That's how you use this macro information to spot which asset class is better to own when this happens right now. So this is about the debt. It's not about 35 trillion, guys. It's about how fast is that debt moving. And it's always going to be a bigger number, right? One day we'll be at 100 trillion. For me, that's not that important. It's how fast it moves. That's what's important.
Amazing stuff, Patrick. It's always fascinating to see how these hidden indicators and these hidden signs can be sort of derived from the charts. If you know where to look, if you lift those rocks and peer underneath, you can find a lot of supporting evidence and background information that does help you with your trading and your investment decisions. If you enjoyed this, don't forget to like, subscribe, and hit the notification bell and join us for the next Talking Trades. Bye-bye for now.